Welcome to the Unstoppable Business Podcast. Dive into top business trends, ideas, and tips to help you run a better business. Let's jump right in today with your host, Arun Mehra. Hi, now today I'm here with Dan, one of our commercial finance managers. And Dan, how are you doing today? All right?
Yeah, I'm not too bad. Aaron, how are you?
Yeah, I'm good, thanks. So, right, what are we talking about today? GP finance, am I right in saying that?
GP finance, yeah. We're going to talk about GP finance today.
So what are the main issues that GPs find when they're trying to raise finance for buy-ins or buying their practice? What are they?
Yeah, so I think what we're seeing at the moment in the GP sector is there's a shortage of new partners coming into healthcare. And the reason for that is a number of reasons. So one is that the number of qualified GPs has reduced. Yep. So you've got less people coming in. And then also you've got a bit of a reluctance from GPs or salary GPs becoming partners. So they don't want to step up and become partners. So obviously that's reducing the amount of partners that you've got. Yep. There's a couple of reasons. Obviously everyone's got sort of pros and cons for that. Obviously for the pros of becoming a partner, so you're going to get more control over the practice. So you're actually going to get a say on what that practice is doing. Obviously, you need to work within the NHS framework, but you're going to get a say on the types of services you want to do and how that practice is run.
Yeah.
Also, it's not all about money, but obviously the financial benefits of becoming a partner as well. So once you become a partner, you'll have that increased salary because you'll get a share of the profits. And then also you'll get a share of the freehold of the practice that is based in. So obviously you will hope that practice over a period of time would increase in value. And then when you become, get to that point of retiring, that has increased in value. So you've got that financial benefit. Obviously in terms of cons, you may be happy being a salary GP. You do that. You got into
nothing wrong with that, is there? Actually,
no. That's what you want to do.
You can walk away and forget about any other pressures in that respect.
Exactly. Absolutely. Yeah. So you've got that. So that's what you want to do. Also, you've got the element of you're getting into a partnership of sort of more partnership of convenience. That you're not choosing the people that you're going to be working with. So that they're the partners at that practice. Sometimes that can cause a little bit of conflict going forward. So you may just be happy, that's not for me. And then also you're going to have the other part of, you're going to be running a small business. GP practices turn over a lot of money and there's a lot of services they do. Yeah. And that could take up a little bit more of your time that maybe you don't want to do. So there are sort of pros and cons to both sort of scenarios really. But, if you've weighed up the pros and cons, you found the practice that you actually want to become a partner in, you like the partners and you like the way everything's going. Your next part of it will be, how do I finance that? How do I arrange my buying loan for that? So there's sort of two elements that you can do it as really. So
actually take one step back, Dan.
Yeah,
so you're a young GP or a GP. You've been working. You've been a GP. You're working a number of years, and opportunities come to buy into a practice you may be working in or another practice, and because of a retiring partner, so you're going to try and raise finance to buy your share of the freehold effectively. That's the situation, really, isn't it? Correct?
Yeah, because within GP practices, there's no goodwill element. Yeah. So when you buy in, you buy a share, and that's normally of a share of the freehold value.
Okay, and that freehold receives a notional rent, which has been predetermined already. Okay, so
yes,
correct. So so the challenge is, how do I raise the money to make it work for you as a buyer, but also potentially for the current owners as well, correct?
Yeah.
Okay.
Yeah, because what will happen is at the point, so normally the scenario is there's a GP one of the partners looking to retire. So what they'll do is they'll normally have the freehold valued, and if if it's worth £1 million for a nice round number, you're buying in. There's 4 partners. And you're buying sort of 25% of that. Yep. So you'll need a loan for circa like 250,000 to buy in. And then what in effect that will do, you buy in, and then the outgoing GP will take their cash and then they'll leave the partnership, and then you become the new partner. So it's sort of as one steps up, one sort of gets removed from the partnership. That's the normal scenario when a buying loan is needed. And so you've got the normal buying loan. So you've got the I say simple version, but what people will tend to do is instead of sort of arranging the loan in the practice name, they'll arrange a loan in their sole name. So it's still a business loan, but it's a business loan to them sort of personally.
Yeah.
And then they will raise that finance. Normally the term 20 to 25 years. Obviously, when they're buying as a partner, these are long-term sort of, visions, and they're doing it for a long period of time. So they'll arrange the loan, and then the issue with the buy-in loan has become is that there's a lot of lenders are not really looking at these now because they're unsecured loans.
Yeah.
You're arranging the loan for 250,000, and it's not against the freehold. It's to them personally, in a good sector where they're going to get a good income from that, and then they have to lend to them personally. So because it's an unsecured loan, the amount of banks that can do it has reduced, unfortunately. Yeah, and so we still think it's a really good sector, and obviously there's no issues there because they're getting a good income, because their actual repayments are going to be done based on their salary and their share of the notional rent.
Yeah.
So that will pretty much fund the loan repayments for the loan over a period of time. So that's how a buying loan sort of tends to work. Very simple. You arrange a loan to, Mr. Smith or Mrs. Smith is going to buy, or Dr. Smith rather, is going to be buying in, and then you arrange a loan, and then that 25% share buys out the other partner.
Okay, but there's an alternative way though, isn't there? Correct.
Yeah, so what we're looking at an alternative way, and there's a few practices that have started to do this as well, because there's, like I said earlier, because there's a shortfall in terms of GPs sort of becoming partners.
Yeah.
What a practice sort of needs to do is try and sort of sweeten the deal a little bit if possible. So to make it a little bit more advantageous for someone buying in, is what they could do is arrange the loan, but as a practice. So instead of them doing a sort of buying loan from themselves, the practice will, in effect, sort of refinance the whole loan. So again, if we use that £1 million figure, so the new partner buying in will still buy in for 250,000 on that £1 million. The other three partners will have their loans, and then
they might be lower in value, those loans, correct?
They may be lower in value, yes. So they may be slightly lower in value. So then you're probably thinking, so why would the other partners want to secure a higher loan against their freehold if they've got a smaller loan? Well, the way, sort of not around that, but a way to sort of smooth that out for the other partners is if they've got smaller loans, so say one's got a loan of maybe 50,000, so the new partner coming in, they'll take a loan of 250,000. The other three partners have got loans of 50,000. What you could do is refinance everything, so you no longer have sort of random, buying loans or some practice loans in the practice name. You have just a one loan for everyone. Yeah. And then the other partners, what they could do in effect is release 200,000 from the equity that they've built up over sort of 15, 20 years within that. And obviously it's their money, and they can do with what they want with that. So I suppose if you look at it at the moment, if you've got maybe a large mortgage and you want to sort of, pay that down, it might be on a high interest rate, pay that 200,000 over to your personal mortgage, either reduce that, or if you're in a good position, pay that off in full. Yeah. And then what that will do is bring all the GPs to a loan parity. So everyone's on 250,000 within the practice. The loans will be paid again by the notional rent. Yeah. And obviously if there's any sort of slight shortfall from drawings, but say that will be the same, and it will be divided by the share that they have, so 25% each. The other advantage is they get the tax benefit of having a business loan, which they wouldn't get on their personal mortgage. They may even want to, again, even in a better position and haven't got a personal mortgage, they might want to put a lump sum into their pension. Now, with the pension changes, they may sort of have that, and obviously that would be a good investment for them going forward. And it's just a good way of securing the loan against the freehold, because that'll bring down the rate as well for the clients. Because if you're doing an unsecured loan, you may be looking at a rate of sort of maybe 3-4%, where if you're doing the loan against the freehold and you're in a nearly fully secure position, because the banks will do 100% finance for GP practices, the rate could be something starting with a 2. So it's a lot cheaper for the partner buying in, and obviously for the other guys who are in the partnership, they're releasing money from the business, which they would have had to wait until someone else retired, and you've got all that money sort of tied up within that business. So you release it a little bit early, and obviously still, either enjoy that money or make that money go to work for you in the meantime.
I think it's a great idea, because I think for the older partners in the partnership, it gives them an opportunity to release their equity before they have to exit, which it gives them the flexibility. Yes, it's a good angle if it can be achieved, and if all partners are in agreement. Ultimately, you've got to get their agreement. Everyone has to be in agreement.
So that's the point, really. I suppose on the first scenario, the buy-in loan, it's you're just arranging that loan for them directly, and obviously they're buying out the partner, taking their money and going. Where in this scenario, the other partners will need to sort of agree to it and sort of come on board with it. But there are practices doing that because they see the benefit of, one, it's nicer for the partner coming in, because again, the loan will be in the practice name. There's only one loan, because sometimes you can buy into a practice. You've arranged a loan for maybe 250,000 to buy in, but the practice may have other loans in the practice name that suddenly you're liable for as well, because you've become a partner. So you sort of take all that out of the equation. You've just got the one loan, and it just sort of puts everyone on an even keel, so that going forward, the partner coming in is happy, the existing partners are hopefully happy that they've managed to release some funds, and then even when you're coming to that point again of someone exiting, they'll just come on to the partnership loan and they'll do the same thing again. So you just keep sort of repeating it. So it sort of takes away the panic of people buying in as well. And even if you haven't got a new partner coming in, but someone's retiring, you can still do this with the other partner. So if, in this scenario, we've used sort of 4, but if someone's retiring and there's 3 staying, but a new partner's not coming in, you can still do that with the other 3 partners. You can still arrange a loan for them to buy out the exiting partner still, and then you just keep the 3 partners instead of 4 going forward. Does that make sense?
That makes sense. So now, for any potential GPs out there, or for any potential accountants out there who have GPs as clients, how should they reach out to you? What can you do? What would you do to help them?
Yeah, so I'm more than happy at Samira, we're more than happy to have a conversation with anyone. We can do an initial chat with them free of charge, just to see if we can help them and sort of take it forward. We do evening calls as well, if that's easier, because we know people are busy during the day, sort of doing appointments, etc. So we could do that and sort of just go through the different scenarios based on their practice as well. So it makes it a little bit more real for them on what we can do, and sort of put some figures together for them so they could understand the difference. Okay. And if they needed us to sort of present that to the practice and do like a joint, we'll do a meeting, school presentation, we're more than happy to do that. So everyone understands the process in doing it. In terms of the practice, they're going to get evaluation as part of the buying anyway. Yeah. So as long as that valuation is on the bank's panel, it shouldn't really cost them much. It shouldn't cost them much more really to do that in terms of putting everything together. So it's it's just an easy way to attract new partners to your business or to the practice.
Okay. All right. Brilliant. Okay. So thank you, Dan. I think that's been really, really useful. So for anyone who's looking to raise finance, if you're a GP or you're an accountant to a GP seeking finance to buy in, give Dan a shout. All his details will follow, and we'll be delighted to help. Okay, thank you, Dan, for today.
Thanks, Simon.
Cheers.
Thanks, bye.
And that's a wrap for another episode of the Unstoppable Business Podcast. We hope you enjoyed it today, and please do share us on social media and make sure you do subscribe. Thank you very much.